Hi guys, it's reputable speaking. Welcome to today's episode of Live Trading Stories. This is actually 67th episode, okay? This is quite a long time. Ever since 2019 when I started off this very series on our Instagram account, official Instagram account. This is the only legit account of the burbness we have on IG. Make sure you do not fall for all the traps, all the kind of like scam accounts, impersonators, bots and so on and so forth. Make sure you stay protected, and to protect yourself, hit the follow button immediately, guys, so that you stay notified and do not confuse us with other scammer impersonators. And like I said, 67th episode, and the very idea of Live Trading Stories has always been to kind of like provide you with valuable knowledge, with insights, with experience, with data, with ideas, market concepts and discussions in order to aid your trading decisions, or basically to deliver information that you may later take and corroborate on in terms of blockchain, if you're a blockchain enthusiast, or also outside crypto, for the traditional finance. And this is exactly what we're going to discuss today, because freshly the new CPI prints have actually kicked in from the official authorities of US government. And as we know, 9.1% year-over-year inflation data over the June, right? So June 2021 versus June 2022, we are looking at 9.1% of increase annually on inflation, on CPI. This is one of the largest increases, individual increases over the last decades, 40 years or even more so. This is pretty wild, this is pretty crazy, and it has tons of actual, I should say, implications for the near term and for the medium term for all of the markets. And taking it straightforward, while sitting here and enjoying Portugal, I do hope you guys are having comfy seats, you guys are having your cup of coffee, right? Because that's going to be another 10 minutes of discussion, which I hope you are going to enjoy alongside me as much as I enjoy talking to you about that. So let's actually hit it straightforward, and this inflation is bad across many factors. First of all, because it's higher than the anticipated one. It's higher than the one that was expected, right? So despite the accelerating rate hikes, despite the even more tightening, and monetary tightening policy that has been implemented by the Fed, by the FOMC meetings, we are not slowing down inflation. In fact, it keeps getting higher and keeps getting stronger and more, I should say, devastating, dramatic than the ones that are anticipated. And this is wrong on so many levels. This is wrong on so many levels, which is directly seen and reflected in the behavior and the price action of the markets, right? If you actually look closely to the charts, of Bitcoin, or also stocks, equities, just large caps, S&P 500, for instance, as a benchmark, you're going to notice this immediate kind of like a spike, tiny bit of an upwards price action yielding, getting closer in the anticipation of the news. And the moment that the news comes out, there was a following kind of like a rule where you buy the rumor, sell the news. This is exactly what happened here today as well, right? So it's pretty wild, because there was, I think, like an immediate drop on Bitcoin within 1 minute. I think it was like a couple of percent of drop, pretty wild, and you're looking at a price action which is downwards oriented. And this was actually a typical reaction. It was not unexpected, right? If the inflation had come off, right, this would have been a little bit of more, easy kind of like a symptom that risk on markets, stocks, cyclical stocks, as in the communication services or the technology or cryptos, through the proxy of correlation, you would see the markets typically yield a little bit more upwards sloping price action. This was not the case, right? I'm just sitting under the tree somehow. This was not the case mainly because what we got instead is this immediate sell-off across the markets, right? So the markets, the way that the markets work is typically, it's all driven by the expectations, or actually by the difference between the expectations and the actual reality, right? So the narratives, the price action tends to build in the anticipation of certain news to be announced and released, which was the case here. And then when the expectations are better than the actual reality, then the markets tend to dump in the proportion, right? Proportionately to the difference between the expectations and the reality. So here, the assumptions were for the year-over-year inflation, annual inflation of June, to be somewhere around 8.7, 8.8. Different kind of audits were made. However, what we got was far worse inflation at 9.1. Okay, so this difference between expectations and the reality, the real print on the CPI reading, this is what this kind of put this negative reaction to the downside on the prices of the assets. And of course, there's always some, I should say, surprise factor. There's always some uncertainty factor. Nothing is set in the markets. Nobody has a crystal ball, to tell you the future, and you never can be certain of any impact. However, more often than not, because the markets are based of human behavior, right? You may argue that if traders, as human beings, as emotional human beings, are affected with negative expectations, as in the outcomes of their expectations are more negative than the anticipated ones, this basically tends to yield negative reactions and disappointment. And this disappointment tends to bring and be reflected and mirror the price action to the downside, right? So, just off the reading, the news selling factor kicked in, decreasing the prices of Bitcoin, decreasing the prices of stocks, and slowing down something that is known as a sector rotation. So let's talk about a little bit of a sector rotation. We do know that the markets, move in financial cycles, and these financial cycles tend to lead economic cycles, right? There is a business cycle, which is an economic cycle, typically kind of coming up with, aligned somehow, with the presidential cycles for your kind of periods. And then you have this financial market cycle driven by the stock market. So it is often said that the stock market is an actual leading indicator of what the economy will look like in the next 7 or 9 months, right? Of course, the date here is arguable. Usually it is said that on average the stock market leads the economy, the business cycle, by 6 to 9 months. More often than not, this is like a assumed average. So assume it's true, and then what you expect is, if you see the deterioration in the stock market prices, well, this in fact becomes a little bit of a self-fulfilling prophecy, and the companies, the firms, lower their ratings, lower their income, lower their overall turnover, right? Generating slower results, decreased performance, and slowing, as a result, the entire economy. Right? So it often happens that the stock market crash tends to, especially if combined with high inflation, tends to put this, economy at risk, right? Because the highly galloping inflation, double-digit inflation, which we have, in so many countries, it does not seem to be stopping, right? Despite all those rate hiking cycles and rate hikes that we already got. There doesn't seem to be much of stopping or slowing down, right? The steam is kind of still on the upwards momentum side, if you ask me. And this is actually, again, yet another proof that what we may see in the near future for the economy is an actual recession. So we'd already got this inverted yield curve, right? For 10-year T-notes maturities versus 2-year or Fed funds rate. We are looking at recession confirmation signals, right? Which in the last decades had actually yielded 100% return, or I should say 100% success rate, right? Each and every single time you would see this inverted yield curve, a situation where the 2-year maturities basically would yield better yields than 10 years. Well, this would imply that the economy is kind of switching weak, right? Because there is bigger demand for the shorter term kind of just bonds, if you will, to an extent. However, do remember, right, this is more more of a just a phrasing case for everybody to understand that a little bit better, because in all honesty, the difference and dependence between the yields, the interest rates, and the bonds is a little bit is first of all inverse, right? Is negative, as in whenever yields increase, it comes mainly because of the government selling off balance sheet and selling off the government bonds, right? So selling the bonds decreases the prices of bonds and at the same time pushes yields higher, and the other way around. If you want to take rates lower, you actually buy the bonds, right, by pumping the price, increasing the demand, and lowering the yields. That's through buying and selling the bonds. The governments and the monetary kind of like policymakers, they tend to rule and govern the economy state, putting it a little bit more into expansion or recession for the cycle. And I do think that, with the inflation prints at 9.1%, which doesn't seem to be stopping, with euro-dollar parity, which is basically unseen since I don't know when, since the very origins, maybe I'd argue. There are many signs, confirmatory evidence committing to this overall economic recession coming ahead. And fear not, though, because economic recession tends to be the best time to invest, right? It is mainly because the recession comes after the bear markets start and kick off and advance, right? And advance as in the overall drawdown, the acceleration to the downside. So after the recession comes, or after it's finally kind of like appeared, in the 2 consecutive quarters of negative GDP, then the markets had already dropped enough to make your buys and purchases profitable more often than not. And now taking it to the sector rotation, you may still see the defensive sectors which are stronger than the benchmark, the S&P 500. There are a couple of cool graphs such as RRG, relative rotation graph, that I keep posting, especially in the premium reports for the Bermudas exclusive members. Definitely, I'll make sure to hit you up with that. Make sure you see and actually just visit the Bermudas for 7 days free with the links I'll attach later in the video description. And you would see that with the relative rotation graphs, the defensive stocks, defensive markets such as staples, utilities, you would look at this within through the proxy of still defensive market. The defensive market is still leading, however, it's slowing down its momentum, right? So the performance, on the relative strength performance side, the defensive stocks are still stronger and better performing than the S&P 500, which is the main kind of like a benchmark. However, this outperformance constantly decreases, right? As in the momentum, the rate of change, if you will, the momentum of outperforming decreases. So this is slowing down in favor of cyclical stocks, right? So just like I said, there is a ETF, very cool ETF kind of like map with XLK, which is the technology sector, XLC, which is the communications services. Those are typical cyclical stocks, right? And they move along with the financial cycles. And when they tend to move stronger and better and faster than the S&P 500, this tends to be a good risk on environment, good risk on kind of like asset time. And this typically, again, is what we call the sector rotation, when the markets tend to change their preferences away from the risk of defensive stocks, which are slowing down right now, towards the risk on asset cyclical stocks and other kind of like derivatives, just like you would have, cyclical derivatives, like cryptocurrencies, right? Or some other risk on assets. So all those things concerned, you're also looking at a cyclical market rotation, which is, I would argue, not necessarily the final confirmation that would be the final nail to the coffin, of the bear market that would just wipe out all the bears and then finish it all once and for all. But instead, we might be talking about the bear market rally, because the bear market with an upcoming recession, which is not there yet, might be an actual confirmation that we are about to see some sort of like a market rally, this bear market rally, this bear market recovery a little bit. Not just kind of like this full, like I said, nailed to the coffin. It's not going to be full complete, and it's like there is no tomorrow pump. But instead, we're going to look at somewhat of a bear market rally, a short-term interruption within this larger bear market sequence. Right, so whenever the recession is confirmed, whenever the recession is in its kind of like full breaking point and its main, I should say, strongest point, this tends to be the best time for the cyclical markets. And the fact that we are slowly starting to see the signs of sector rotation away from the risk on and towards the risk on and away from the risk off, away from defensive and towards the offensive stocks, I would argue that this may be in favor of the short-term bear market rally, which overall, again, is a certain form of confirmation that there is something going on in this bear market, that this bear market is a little bit exhausted already, and while it does not necessarily need to be over 100% and complete, right, this is like the first sign, this first positive sign, this first glimpse of light, this first literally this first string of light in the tunnel, if you will, right? So I think the persistence and within the bear market, the persistence to educate, to learn, to improve the knowledge, to prepare, to build behind the scenes is exactly what we should all be working on and focusing on. And that's exactly what I'm focusing on in the Burb Nest. And that's, guys, exactly, if you enjoyed this very session, this live trading stories number 67, I want to give you guys an update. I want to give you a 7 days free trial to the Burb Nest community. And this is actually very good news. I'm pretty excited for it. We've just got verified on Discord. And this confirms our authenticity, that we are authentic, that we are recognizable, that we are actually mature enough and large enough ever since 2017, that we just got verified, right? And you being part of this verified community for 7 days free is exactly what I'm getting you guys. So if you are interested, and if you're serious about the money, if you really want to change, and if you want to focus on the bear market, actual education, this couldn't be a better time, could not be a better time to get started in improving your knowledge and getting to know how the things should be in real practice. If you guys are ready for it, make sure you stay tuned. Make sure you follow us on the Burb Nest account on Instagram. This is the only legit account I have, so make sure you follow this. If you enjoyed this series, if you enjoyed this stream, make sure you hit the like button as well. Leave some kind comments and questions if you have any, and check out the video description, because I'm going to put in the link for your 7 days free trial. If you guys are ready, if you're not there to goof around, if you're serious about your money and investments, that's 7 days for you, for free of any charge, no credit cards required. And I want to see you guys there with your questions. God bless you all, and I see you around. Bye bye.